right, friends, how you doing? Ernie here, and this is 0 Days to Expiration, episode number 38 of the YouTube podcast. And today we're going to talk about volume profile and the third dimension and what that means. Now, yesterday we had to talk about how we go about our profit management and the profit management framework. And if you're interested in that, just go back somewhere, like here or here. There'll be a link to the video. And that was about how we actually slice and dice the session in order to get our best opportunity for taking profit. And I like to call that the two-dimensional framework. And what that really means is that we have a very clear recognition of how premium decays over a period of time and its nature, and that there are certain parts of the day where you have to treat it uniquely. So in the first part of the day, it's going flat, kind of flat, not really decaying that much. Second part of the day, it starts to dogleg, and the third part of the day, it's falling off of a cliff. Clearly, that takes three different approaches to how you're going to set up your hold or fold decisions on your strategy. Now, there is a third dimension, and that is the underlying market context. So it's one thing to know where and when you are in order to make those decisions, and whether or not it's violating the walls or the limits that you create. But you also need that third dimension that helps you kind of fine-tune that and know whether or not, hey, I should stay in with this, or yeah, I got to get out now. Now, one of the things that we also know is that as we're getting closer and closer to expiration, if we're not sitting directly in the center of a butterfly, then we're on the edge and we're experiencing extreme gamma risk. So that gamma risk is enough to get your mind going. You start thinking that, damn, it just moved down just a couple of points and I lost like $300 or $400. What's going to happen if it moves down 10 points? I'm going to be SOL. However, if there is a good reason to stick it out, even within the parameters that you've chosen, well, you're going to want to know what that is. And that is what the third dimension is, the underlying market structure as it is defined by volume profile. Now, we also use some price action techniques to identify whether or not there's a good chance price will be going one way or the other if it exceeds some sort of neckline or level or whatever. But volume profile is our primary way of discovering, at least planning out is probably a better word. With volume profile, we can create a number of scenarios that are potential. And so when we're sitting in that spot, let's say we're right at the edge of the profit tent on our butterfly, and we want to know, man, it's getting along, it's like 230, 245. Should we hold it out? Is there a chance that it's going to go up or down? What are the odds? What will I do if it does go to this level or down to this level? Can I feel confident that it'll hold or not? And so that's what volume profile does for us. Now, I know that a lot of traders use volume profile in a session-oriented way. So they'll look at the session profile, and from that, they try to determine the support and resistance areas, or whether or not we're going to continue with the trending market or not. And by and large, I'm going to say this. Session profiles on a volume profile for a day trader is absolutely useless. I believe that it is no more useful than Fibonacci or Elliott wave, which I believe are nothing more than numerology just made up. And I feel the same way about session profile because it was born out of market profile. And market profile was made very popular by Dalton and others. And it was supposed to sort of enlighten people about how markets and how market theory and auction theory should work. And I say it's all bunk, quite frankly. There's no real statistical evidence that any of the patterns that they've come up with show any significance. And I can say this with absolute authority because I've actually created strategies, literally hundreds of strategies over time, and traded tens of millions of dollars with these strategies and these concepts in mind, and have never really found anything of real import that you can hang your hat on. However, over the past, 6 years, 7 years or so, I discovered something within volume profile that was quite unique, that was way apart from session profiles. And that was the visible range. When I started looking at the visible range, and you'll know what I'm talking about in TradingView, the visible range aspect of volume profile in TradingView means that anything that is visible within the chart, it'll create a profile for that. And, that's kind of cool. Well, does that mean, do I look at a day, a week, a month, a year, a decade? Well, it turns out that the most powerful aspects of volume profile are when you look at volume, abrupt changes in volume that repeat themselves over years and years. And I know that that might sound a little odd, but there's a very famous mathematician that I've known about this mathematician for many, many years because I've always been into math, but it wasn't until recently that I discovered some academic work that he had done, and then other people that followed on with it. He had come up with this idea of systems memory, that within natural systems, actually he was studying water basins. Who I'm speaking of is Benoit Mandelbrot. And you may be familiar with him as the person who created the Mandelbrot set. That's those graphics, those really swirly graphics that have, no matter how deep you go into it, it's constantly more to it. Or fractal geometry, that person. Well, he's considered one of the most brilliant mathematicians of our time, or of all time, quite frankly. And he came up with this idea, or really it's more than an idea, a hypothesis that's been proven out, of system memory. And he originally looked at it observing natural water basins and how water tended to achieve a certain level regardless of the amount of rainfall. And it seemed that the levels that it achieved were things that repeated year in, year out based on catastrophic events that happened over the course of decades. And he called this system memory. And then he, of course, he was very into the stock market. And he developed a very similar theory, or an analog to that, and that is market memory. So what that really means is that the market over time, in the same way that a water basin will maybe through flood zones or other things create these indelible marks in the landscape that cause water and the flow of water to behave in certain ways, he found the same thing happen with volume. So where volume would abruptly change, it seems that that became persistent from one year to the next, decade to decade. And you can see this very clearly when you look at a volume profile over the course of 1, 2, 3, 4, 5 years. You'll see that the same structures continue to persist. In other words, probably better to just show you. You love the squeak in the background? That's Zuri down here. Zuri the Ridgeback. She's playing with her squeak toy. Here, go ahead. That's yours. So probably best to go directly to volume profile and show you exactly what I'm talking about. And then we'll review our profit management framework and then how volume profile can be used to make very important decisions that could mean the difference between making a few $100s or a few $1,000s. All right. So what we're looking at here, well, this is Tesla. And it works, by the way, volume profile, this technique works on any asset that has volume. Now, we trade options on the SPX or the index, and obviously there's no volume on the SPX. That's because it's an index. It's calculated. There is nothing to have volume with. You can't actually trade it. So what we do is we look at the E-mini S&P, which is the equivalent of the SPX, only it's a futures contract. It does have volume. You can trade it. So when we're looking at levels, very, very specific levels, we need to know the difference between the futures and the SPX. It never really varies by much more than 10 or 20, maybe 30 points at its maximum when there's the beginning of a futures contract, and then it reaches parity as it gets closer to the expiration of that futures contract. But by keeping track of that, we always know whatever these levels are that we set up, we can very easily translate them to the SPX. So that's one point. So let's, first of all, we'll go to the E-mini S&P. And by the way, we had a fantastic trade today. Now, remember I said it's, now I'm looking at a 10-second chart. So every bar on here only represents 10 seconds. So this is a very, very, very tight thing. So the profile here is of little use to me. Well, it's not necessarily true. Here we can start looking at it from a point of view of order flow, but that's a completely different subject. So let's move out a little bit. This is a 5-minute chart. Now you'll notice that there are these lines that I've drawn here, these yellow lines and purple lines, and you'll see how that becomes very important. And I'll zoom out a little bit more, maybe to an hour. And one thing that you may notice is that price is kind of respecting these lines. Here you can see it down here, finding support and resistance, more support, an inflection point, right? So all of that is very important, and what I want to show you and how we actually discover these lines. So let's move out even further to 4 hours. Now, these purple lines, they represent specific areas that we call nodes, and then the yellow lines are sort of the antinodes. They're the lowest points of volume, where in between the purple lines is the highest points of volume. So you can see that when you get outside of the purple lines or the nodes, you tend to move very fast. When you're inside of the purple lines, you tend to consolidate. So that's a fundamental thing, first of all, that distinguishes markets. I mean, they are either consolidating or they're trending. They're trending outside of nodes, and they're consolidating inside of nodes. Very, very important point. So let's go to a daily chart. Now, the profile that I'm showing here, it's showing me the profile for everything that's visible in this chart. From back here in, I guess, October of 2022 until the present day. Now, I can condense this chart by grabbing the timeline and moving it in so that I can show more time. And then you'll see the profile will update based on what is shown in the chart. Now, I can keep on going until I see all the available price movement that's happened forever, in at least in this range of prices that I'm interested in. All right? So I can go all the way back. I mean, I'm going all the way back to 2021. So there's 2 years worth of data. And I want you to look very closely here. You'll see that there are indentations, there are nodes, and the lack of nodes within here. Now, if we were just totally random, then you would expect there not to be these big nodes and valleys to exist. Everything would be kind of a very random sort of smoother line, I guess, or not this kind of undulating, jagged thing. What you're seeing here is markets tending to want to trade around certain areas and not trade around other areas, and dramatic drops from the amount of volume or the amount of time it's spent trading to other areas where it's not trading. These dramatic drops in volume or increases in volume create indelible marks in the market. And this is what we call the market structure, sort of the market landscape. You can almost look at this as being a mountainous range, and the valleys inside the range like vast desert-like plains, right? And in those vast desert-like plains, you want to move fast because it's hot and you're going to get stuck there. You don't want to get stuck there, so you want to go from one area of value to the other. That's another way you can look at these nodes, as areas of value. When you get out of one node, you're searching for the next area of value, and you quickly move. That's why it moves quick. There's less liquidity when you get out of a node, and you search for the next node. Now, in this case, we have this kind of very loosely tied together lesser nodes. But once we get out of this big node here that we've been in for a long, long time, we break out. And you can see that that's exactly what's happening here. We're breaking out. If you look very closely, you can see that bar, we're breaking out. And that's because we're coming into this area that has much less liquidity. And so we can break out easily and create these very long bars of movement. And so that's exactly what's happening here. Now, you'll see that the yellow lines, they are identifying the deepest crevices. Now, these deep crevices are areas where the market, for whatever reason, has decided it doesn't want to go. And so when the market moves throughout this structure, it behaves in certain ways. Like I said, as it's moving in between the nodes, it's moving relatively quickly. When it gets in the node, it tends to consolidate. And when it comes to the edge of these nodes or to these deep crevices, it pauses. And those are the areas where you're going to find support and resistance. Support from on top and resistance from underneath. And also the change in tenor or, I guess, excitement of price as it moves across those. And it moves fast through the less airy or the less liquid, more airy areas, and then slows down when it gets into these nodes. All right, so these are all very important points, and how we can use them. First of all, we want to mark them up when we're in this big view so that we can see these with very great clarity. We can see the edges of these, and we try to put lines that best represent the abrupt change in volume to little volume, a lot of volume to little volume. Very similar to when you, in a water basin, you can see where flood marks are made, right? So that's really the concept. Now, all of this has been proven out by, as I had mentioned earlier, Benoit Mandelbrot and many other mathematicians, famous mathematicians that have done academic papers talking about this in far more academic speak. Now, I discovered this without any math, so to speak, but just noticing it just on the heuristics and just seeing it with my own eyes. And over time, I started to develop that affinity towards this and started to mark it up and realize that I had found something quite remarkable. Because when I zoom in on these places, as you saw earlier, I start seeing that these lines that I've drawn that were quite objective in terms of how I found them, I mean, perfectly objective, that they are providing support and resistance to the short-term market movement. All right, so that's an extremely important point. All right, so as I said, when we zoom in, let's go down to that 5-minute bar. We've already seen this, actually. And here's the lines. And they start becoming important. And from these lines, here's the real cat takeaway from this. Let me get back to the big head. All right, so the big takeaway from all of this is that we can create this market structure from these lines, and on any particular day, we can make assumptions or create scenarios of where we think price is going to go based on how we know that price acts as it crosses this structure. As I said, as it's crossing a node, it tends to stay inside the node. When it gets out of the node, it tends to try to find another node. It comes to these yellow lines. That's what I call the LVLs, the low volume levels. And they act like gateways. And they're either going to reject that price trying to traverse across that span of low liquidity, or they allow it through to the next one until it keeps on, or maybe eventually finds another node where it will then find value and hang out there. So what you can do at the beginning of each trading day is that you can set up a number of scenarios on how you think price might go if you're going to anticipate a strong trending day, either going up or going down, or maybe a range-bound day. Regardless of how it is, you can use these nodes and these lines to plot out how you think that price is going to behave. And you'll be absolutely amazed how accurate some of your plots or scenarios are going to play out. Now remember, these are just scenarios. You don't know definitively which way the market's going to go. However, with the structure, you can create scenarios regardless of which way the market goes. So if it goes one way, that structure is probably going to play out and the way you draw in your path. If it goes the other way, you can follow that path. And from this, you can develop more sophisticated contextual strategies in your volume, with your volume profile in your 0 DTE day trade. So as price is moving about during the day, whether it's a trending day or a range-bound day or however it is, and you have plotted out these scenarios and you've moved into an area that's of interest and you want to know whether or not you should hold or fold your position in order to collect your premium, you use the volume profile as sort of your guide within your big parameters, your big ultimate limits that you're going to allow price to move, and then make decisions inside of those areas. So this is the third dimension that is inside of our strategy profit management framework. So again, the big picture, as I said, go back yesterday and take a look at that podcast where I talk and do a whiteboard session on how we actually define the where and the when of our framework. And then once we're in one of those, the intersections of those where and whens, that's where we apply a more nuanced or third dimension where we use primarily volume profile. We can also use price action, but it's primarily volume profile to make those more qualitative decisions that will make us money. So there you go. That is how we use volume profile in 0 DTE profit management. So I really don't have much more to say. That's about it. I have to get back to the trading. We've had a couple of great trades today. People were making money in our service today. That's been kind of a rarity over the past 6 weeks because price has just been going sideways. So our opportunities are fleeting. Now, of course, knowing that opportunities are fleeting, sometimes they come in bunches, sometimes they're very sparse. You have to be there all the time. And the only way to really be there with certainty and with the kind of confidence is with an asymmetric risk to reward trade. So in other words, you want a very tiny risk for a large potential reward. It's the only way that you can have the staying power in an uncertain market where you need to be there for when that opportunity appears. So that's what we do. We're there when the opportunity appears and we pounce on it. And today was definitely a day of pouncing. All right. Yesterday was too, by the way. All right. That's about it. Thank you very much. Peace to you all. And we'll see you next time. Music. All right, take care.